CNBC-TV18 turns 23 today. We would like to take this opportunity to thank all the viewers for your continued support, faith and trust over all these years. We continue to remain India's #1 business news channel, and thank you once again for all the support. Let's begin with the big story this evening. Yes, the RBI's Monetary Policy Committee hiked its benchmark repo rate by 35 basis points, capping its 5th hike this year, also the lowest in the rate hike cycle. 5 out of MPC's 6 members voted in favor of the rate hike. The repo, which is the rate at which RBI lends to banks, now stands at 6.2%. It is the highest since August 2018. The Monetary Policy Committee also decided to remain focused on withdrawal of accommodation stance. The RBI also trimmed its GDP growth forecast for FY23 to 6.8% from 7% earlier, citing geopolitical tensions and global slowdown. It expects the first quarter of the next fiscal year to record a GDP growth of 7.1%. Meanwhile, the inflation forecast for FY23 has been retained at 6.7%. Governor Shaktikanta Das said that inflation is expected to moderate, but the battle against inflation is not over. He added that the course of the future policy will duly consider new data releases and the evolving outlook of the economy. Latha Venkatesh is here with her take on the monetary policy.
Yes, as everyone has pointed out, 35 basis was exactly as expected. What was unexpected was the Reserve Bank's determination to chase down inflation. Just listen to what the governor and the deputy governor said.
India's GDP growth is resilient. It is holding on and it is doing well in a world of slowing growth and possibilities of recession across several countries.
The worst of inflation is over, but the moderation of inflation will be very grudging, very uneven. So we must shepherd inflation first firmly into the tolerance band and then to the target.
Okay, so for the key takeaways for me, one, the governor is very confident of growth. So he wants to use that cushion to do some good macros building, which is bringing down inflation. The second takeaway is, the governor clearly told me in a reply, policy is still accommodative. Look, liquidity is surplus and real rates are negative. That is, interest rate is lower than the inflation rate. So that clearly indicates he thinks there is space for more rate hikes. That is a clear takeaway. The next takeaway is, the sentence where they explain their stance, he has he has added a phrase that we have to break the persistence of core inflation. That sentence didn't exist before. Now, this is a new addition, which means Reserve Bank is going to start monitoring core inflation. So far, they've never put it on the table so clearly. So that becomes another takeaway and a hawkish one at that. And then Dr. Patra's statement that inflation will come down very grudgingly. The Reserve Bank seems very clear that it's not going to be an easy fight against inflation. It's going to come down slowly. That's again a hint that they may have to do more work, which means more rate hikes. And finally, the conclusion we can therefore come to is one more hike seems a given, because they are saying we have, it is still accommodative policy. Whether there will be a second will depend on how core inflation behaves. Now, even if the March inflation forecast has been raised by RBI from earlier 5.8 to 5.9, what if it is 6? That means for 15 months, they are still above target. So chances are that will increase the chances of yet another hike. The peak rate could be 6.5. It's definitely going to be 6.5. It could even be 6.75. This was the shock for the market. The market had factored in possibly a peak at 6.25 and then some pause. Today, you saw all the yields going up, both the spot yields as well as the overnight index swap yields, as the market started pricing in one more rate hike in February.
Governor has kept the door open for a possible small hike in the next policy, possible. That is perhaps will emanate out depending on the data that comes through. So at most, I repeat, 20-25 basis points hike in rates in the next policy, but then there will, to my mind, be a clear stop thereafter.
I think deposit rates will be a function of how we look at our asset liability mismatch. So I think we are very closely looking at it, and what the position is. Based upon that, if need be, we'll calibrate our deposit rates too.
I think the stance is that we need to get inflation under control, and that also very clearly implies maybe another hike of 25 basis points before things stabilize. You know, the hope, while the inflation is coming down, RBI has also very clearly tempered the growth expectations on the GDP side. So it's a balancing act.
So Indian interest rates, even though have gone up, but as far as the access to, on a relative basis, to domestic markets is attractive. That is why the cost of financing has gone up, but I don't think because of which any company will hold the capex, because the long-term story of India is very encouraging.